Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Junk Bonds Investing, a high-yield guide for 2024. Ever wondered if high returns are worth the risk? Junk bonds, often called high-yield bonds, might be your answer. These bonds are a bit like betting on the underdog. They're issued by companies with lower credit ratings, which makes them riskier, but they come with the promise of higher payouts. Junk bonds got their start in the 1980s when financial markets saw their potential. Since then, they've proven to be a dynamic part of investing, offering substantial yields to those willing to take the plunge. In this video, we'll break down the essentials of junk bond investing. You'll learn why they're considered high risk, high reward, and how you can navigate this thrilling market safely. Stay tuned to uncover the secrets of making junk bonds work for you. What are junk bonds? When you hear the term, junk bonds, it might sound risky, and you'd be right. Junk bonds, also known as high-yield bonds, offer a unique investment opportunity with higher risks and rewards. But what exactly are they, and why do they stand out? Let's dig in. Definition and characteristics. Junk bonds are a type of corporate bond that comes with a lower credit rating but offers higher yields than investment-grade bonds. Here's what sets them apart. High yield. Junk bonds provide a higher interest rate compared to safer, investment-grade bonds. This is their main attraction. Low credit rating. Issued by companies with a low credit rating, these bonds are deemed riskier by rating agencies. Higher default risk. Higher yield comes at a price. There's a greater chance that the issuing company may default on its debt. In essence, junk bonds are like the daredevil of the bond world. They can soar high with big returns but also come crashing down if things go south. Credit ratings explained. Credit rating agencies like Moody's, S&P Global, and Fitch play a crucial role in assessing the risk levels of bonds. They classify bonds from investment grade to junk based on the issuer's financial health. Investment grade bonds, high ratings, AAA to BBB, indicating low risk. Junk bonds, ratings below BBB, indicating higher risk. Junk bonds are often rated BB or below. These ratings signal that the issuing company has more financial challenges and uncertainties. It's like getting a B on your report card, compared to an A+, not great, but not entirely failing either. In summary, junk bonds offer a mix of high potential rewards and risks. Understanding their characteristics and credit ratings can help you make smarter investment choices. Ready to dive deeper into the world of junk bonds? Let's keep exploring. The risks and rewards of junk bonds. Investing in junk bonds is like a roller coaster. The highs can be exhilarating, but you must be ready for the drops. Junk bonds are enticing because they promise high returns but come with higher risks. Let's explore the potential rewards and risks of adding junk bonds to your investment portfolio. High yield potential. Junk bonds can offer some of the highest returns available in the bond market. Here's why. Higher interest rates. Companies issuing junk bonds have lower credit ratings. To attract investors, they offer higher interest rates. This translates into more income for you. Growth opportunities. Smaller or struggling companies often issue these bonds. If the company turns around, the value of the bond can skyrocket. Diversification. Adding junk bonds to your investment mix can diversify your portfolio. This diversification can balance risks and increase potential returns. Imagine junk bonds as that restaurant in town with mixed reviews. It might have a shabby exterior, low credit rating, but the food, returns, could be phenomenal. However, there's always a risk that the experience might be disappointing, default risk. Risk factors. Investing in junk bonds isn't for the faint-hearted. Here are the main risks to consider. Default risk. This is the chance that the bond issuer won't be able to pay back the principal or interest. Companies issuing junk bonds often face financial difficulties, raising the likelihood of default. Interest rate risk. Bond prices and interest rates move in opposite directions. If interest rates rise, the price of existing bonds typically falls. Junk bonds are more sensitive to these fluctuations, especially if they have longer maturities. Market risk. Economic downturns or poor market conditions can negatively impact junk bonds. Unlike investment-grade bonds, which are more stable, junk bonds can see significant price swings during market turbulence. To put it simply, junk bonds are like a high-stakes poker game. The rewards can be big, but the risks are just as high. You need to be willing to accept the possibility of losing to gain those high returns. In understanding the balance between risk and reward, junk bonds are an investment that requires careful consideration and strategy. Knowing both the potential benefits and pitfalls can help you navigate this volatile yet exciting market confidently. How to invest in junk bonds. Investing in junk bonds can be a thrilling way to diversify your portfolio and achieve higher returns. However, it requires a clear understanding of your options and strategies. Here's a breakdown of how you can start investing in junk bonds. Direct investment. Buying junk bonds directly is a straightforward way to add them to your portfolio. You can purchase individual bonds through brokers or bond markets. Here's how to do it. Find a broker. Start by selecting a reliable broker who offers a range of junk bonds. Major brokerage firms like Fidelity, Charles Schwab, and E-Trade provide platforms where you can trade these bonds. Research bonds. Look for bonds issued by companies you believe have potential. You'll want to study their financial health and future prospects. Ensure the reward justifies the risk. Place your order. Once you've done your homework, place an order through your broker's platform. Don't forget to monitor the bond's performance regularly, as market conditions can change. Buying junk bonds directly can give you control over your investments, but it does come with increased risk. You need to be diligent about research and monitoring. Mutual funds and ETFs. If direct investment seems too risky or complex, mutual funds and ETFs offer a simpler, diversified way to invest in junk bonds. Here's what you need to know. Mutual funds. These funds pool money from multiple investors to buy a wide range of junk bonds. They are managed by professional fund managers who make the investment decisions. This means less work for you. Some popular junk bond mutual funds include the Fidelity Capital and Income Fund and the Vanguard High Yield Corporate Fund. ETFs. Exchange-traded funds also provide access to a basket of junk bonds but are traded like stocks on exchanges. They offer liquidity and flexibility, allowing you to buy and sell easily. Well-known junk bond ETFs include the iShares iBoxx Dollar High Yield Corporate Bond ETF and the SPDR Bloomberg Barclays High Yield Bond ETF. Both mutual funds and ETFs spread your investment across many bonds, reducing the risk of any single bond defaulting. They are an excellent choice for those new to junk bonds or those seeking a more hands-off approach. Diversification strategies. Diversification is key to managing the risks associated with junk bonds. Here are some strategies to ensure your portfolio remains well-balanced. Mix bond types. Don't put all your money into junk bonds. Include investment-grade bonds, government bonds, and other fixed-income securities to create a balanced bond portfolio. Sector diversification. Invest in junk bonds from various industries. This reduces the risk that a downturn in one sector will negatively impact your entire portfolio. Global exposure. Consider bonds from different countries. This can mitigate the risk of economic downturns affecting all your investments at once. Stagger maturities. Buy bonds with different maturity dates. This minimizes the impact of interest rate changes on your portfolio. By diversifying your investments, you can reduce the risk while still enjoying the higher yields that junk bonds offer. Remember, the goal is to balance risk and reward effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.